Okay, picture this. It's the morning of August 18th, 2026. You wake up, grab your phone, and tap open your banking app, fully expecting to just check your balance or pay a quick bill before starting your day. But instead of seeing your money, you're met with a blank screen, just a spinning error message. Well, on this particular morning, millions of Halifax, Lloyds, and Bank of Scotland customers woke up to exactly this nightmare. They were completely 100% locked out. Payments failed, bills went unpaid, people were literally financially paralyzed before they'd even had their morning coffee. So what actually happens when the digital representation of your hard-earned money just vanishes into thin air? Let's dive right into this. Today in this explainer, we're going to move past the initial shock of those failing payments and break down the real anatomy of a massive digital infrastructure failure. We'll look at what went wrong, the root causes, and what it all means for you. To truly wrap our heads around the gravity of this event, we have to look at the sheer scale of it. 26 million. That is the customer base of the Lloyds Banking Group. Now, while not every single one of those 26 million people lost access at the exact same microsecond, this number just highlights that we are not talking about some minor isolated glitch here. When a network this incredibly vast goes offline, it becomes a systemic threat to the daily functioning of the entire economy. Now, what's really interesting about this breakdown is where things actually broke. The data from Down Detector is crystal clear. A massive 67% of the complaints came straight from the mobile app itself. Compare that to just 14% for general login issues and a measly 10% for the website. The mobile app, which, let's face it, is how most of us interact with our money these days, was the undeniable point of failure here, completely dwarfing any traditional website problems. And the sheer velocity of the problem was staggering. Within just a few hours of the midday crash, Down Detector logged over 2,500 individual complaints for Lloyds alone, and that was happening right alongside over 1,000 complaints for Halifax and another 340 for Bank of Scotland. It was a massive domino effect, really cementing how rapidly this escalated. People across the entire country were realizing, all at the exact same time, that they were entirely cut off from their own funds. Moving on to the real-world consequences. Because when a major banking app goes down, it essentially freezes real life. Just listen to the visceral panic from this actual customer. They said, "I was about to pay my rent and now I can't. This is unacceptable." Think about the real emotion behind those words. We aren't just talking about a minor inconvenience, like not being able to buy a coffee. Digital banking is no longer a luxury. It's essential, life-sustaining infrastructure. When it fails, basic human needs, like, keeping a roof over your head, are instantly threatened. And the impact goes way, way beyond just the individual consumer. Another customer shared this: "I run a small business and I can't pay my staff today." This escalates the stakes dramatically, doesn't it? A sudden outage like this sends severe ripple effects right through local economies. Suppliers don't get paid, shipments grind to a halt, and hardworking staff are left without their expected wages. The friction this introduces into the economy in just a matter of hours is immense. So what about the official response versus the reality? When a crisis of this magnitude hits, you expect immediate, transparent communication, right? Well, it alarmingly took hours for the banks to even officially acknowledge the crisis that was unfolding for their users. And when the statement finally arrived, this is what we got. A spokesperson said, "We are aware some customers are having issues. We are working to resolve this. We are sorry for any inconvenience." Let's dissect this for a second, because it's an incredibly bland statement. It notably lacks two absolutely critical things: a specific cause and a timeline for a resolution. Telling people whose rent payments are literally bouncing that you're working to resolve this without giving them a timeline, that severely, severely erodes customer trust. Let's zoom out and see how this builds into a much larger and honestly more concerning picture. This wasn't just an isolated bad day. In January and February of 2025, there were payday outages. In June of 2025, major login issues plagued these exact same systems. All of this leading directly up to the massive app crash in August 2026. This reveals a pretty alarming pattern of recurring failures. So the crucial point here is this stark contrast. On one side, we have generic corporate downplaying, the standard apologies for the inconvenience. But on the other side, we have the harsh reality of recurring systemic breaches. We really have to recognize that these aren't just random flukes. They are historically severe symptoms of a much deeper, unaddressed institutional problem. Actually, let me give you the most terrifying example of this systemic fragility. Back in March 2025, a software defect caused by an overnight IT update resulted in 447,000 customers having their personal financial data exposed. And no, it wasn't exposed to hackers in some dark web leak. It was worse. Customers were logging into their own accounts and seeing entirely different strangers' transactions, account balances, and payment histories. Your private financial life fully visible to a random person on the internet? No way. The bank was ultimately forced to pay over £200,000 in compensation for that specific data mixing breach. But to put that into perspective, £200,000 is an absolute drop in the ocean for a massive banking group. The real cost? The immense, unquantifiable damage to institutional trust. That's something you simply can't put a price tag on. I mean, how do you ever fully trust a system again after logging in and seeing a complete stranger's salary? Let's pull back to the macro level to see just how widespread this really is. A March 2025 Treasury Select Committee report found that 9 of the top UK banks experienced over 800 hours of unforeseen tech outages. That spanned 158 separate incidents over just 2 years. 800 hours. That is a staggering amount of downtime for systems that are supposedly operational and secure 24 hours a day, 7 days a week. Which brings us to the big question. Why are these systems failing? Why are the digital vaults holding our life savings so fragile? The answer largely boils down to this core concept: technical debt. It's basically the compounding cost and fragility of keeping decades-old legacy banking platforms alive while forcefully integrating them with modern, flashy digital apps. It is literally like trying to put a Ferrari engine into a horse-drawn carriage. When these heavily patched, aging systems inevitably break, the failures just cascade uncontrollably across the whole network. And this brilliantly illustrates the compounding factors dragging the whole thing down. First, you've got those aging legacy systems we just talked about. Second, surging transaction volumes, especially on payday weekends, where the system is pushed to its absolute limit. Third, open banking API complexities. Basically, every time you connect your bank to a budgeting app, you introduce a brand new point of failure. And finally, constant cybersecurity threats, which force banks to endlessly patch an already fragile foundation. So protecting your digital wallet, what do we actually do about all of this? Until banks decide to fundamentally invest in modernizing their deep-level infrastructure instead of just slapping a new coat of paint on their mobile apps, we have to anticipate more of these outages. So let's talk about how you can protect yourself. On a systemic level, we absolutely must demand regulatory standards that require greater resilience. Digital banking is indisputably the backbone of our modern economy now. We need to push for strict standards that demand actual, proven technological resilience from our financial institutions, holding them totally accountable when they fail to give us access to our own money. But on a personal day-to-day level, here is an actionable checklist you can implement right now. Step 1, diversify your bank providers. Please don't keep all your money under one single banking group umbrella. Step 2, keep some emergency physical cash on hand for absolute necessities during an outage. Step 3, maintain a backup account with a totally separate institution. And Step 4, always verify that systems are fully operational before you attempt any huge time-sensitive payments. Taking these micro-level steps seriously can honestly save you a world of stress. We've covered a ton of ground today in this explainer, from the massive scale of the August outage all the way down to the technical debt causing it all. But I want to leave you with this final, vital question to ponder. Is your digital money truly as secure as you think? Take a hard look at your own banking safety nets this week, because in today's fragile digital economy, being prepared and proactive is for sure your best asset. Thanks so much for joining me, and stay protected out there.